and gold could, even if it just went to 8,500, it would then be matching the percentage dynamics of its two prior bulls. I think that the $50 highs, you're looking at one of them there, and there was one back in 1980, are going to be blown to hell out. And we're going to end up with a surge, this move that we're in right now, that's likely to only pause in the $65 to $70 range. I just think that in the next 3 months, you're likely to see some of these dynamics astound you. I don't think the incremental nature of the bull market we've seen in gold and silver, which has now gone more accelerated, admittedly, we're going to go even more accelerated.
The Fed indicated that we're going to get at least 2 more rate cuts between now and the end of the year. So bullish, bullish, bullish. And so gold's got no place to go but up. Silver's got no place to go but up.
The precious metals markets are entering a decisive moment that could reshape the investment landscape for years to come. Gold has already surged far beyond its 2011 highs, and silver is beginning to show the same potential. Historical comparisons suggest that we are not even halfway through this bull cycle, with prior runs producing eightfold moves under less intense conditions. The acceleration now underway signals that both gold and silver could soon reach levels few investors currently anticipate. As equity markets wobble, particularly in the US, capital rotation appears inevitable, and when traditional assets crack, history shows that wealth does not disappear, it simply migrates. MichaelOliver, a respected momentum analyst, has highlighted how long-term structures are breaking down in equities even as monetary metals strengthen. He argues that silver is poised to outperform, with silver miners already showing signs of leadership against gold miners. Complementing this view, economist Peter Schiff stresses that when the stock market weakens, money flows into real stores of value, with gold and silver positioned to benefit disproportionately. Together, their insights paint a picture of a financial shift where the metals are not just defensive assets, but potential drivers of substantial gains. Investors who recognize these dynamics early will be positioned to benefit from what could be one of the most powerful wealth transfers in modern financial history. Now, we present the clips from their interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you and enjoy the video.
Gold right now is 3.5-fold off of its bear low. In 2015, it was at 1,045 low. It's tripled in a half, okay? If you do a logarithmic scale of gold, a ratio scale of its moves since 1975, when the government made it legal again, there have been 2 prior bull markets that were 8-fold moves. The one you're looking at there that went to 1980 and the one that peaked in 2011. If you go back to the bear low before that, different amount of years it took, but still there were 8-fold bull markets. We've gone up 3.5-fold. So yeah, you might want to look at the price chart right now and say, oh my gosh, that looks vertical. Yeah, fine. It's nowhere near even half what those prior bull markets did under conditions that are far less dynamic and pending fundamentally as the one we're in now, especially if you break the stock market. Because at that point, you're going to have all kinds of debt crises revealed, errors exposed. And I think a lot of them won't just be in AI, by the way. They're going to be in the financial sector, which we're keenly watching right now, where the central banks then go berserk. But what does that benefit? We know that when they start cutting rates, it didn't help the prior bear market stop. They just went on, okay? Gold, it's just more fuel for gold. I think these conditions are now set. And gold could, even if it just went to 8,500, it would then be matching the percentage dynamics of its 2 prior bulls. I don't know that it even stopped there, because frankly, the world is different than it was then in terms of fundamental dynamics and things. So when people say, oh, it's overdone, geez, it's only freshly emerged from that range you see there. So, it's hardly overdone anyway. And I think people need to be aware of that. It shot up nicely in April. The stock market collapsed. It went up. In fact, it went up from Jan to April. Stock went down from Jan to April. Okay, total opposites. And then when the stock market decided to go up, you think, well, the guys that bought gold as an alternative to stocks, shouldn't they be selling? It didn't go down. It went sideways. It went to sleep. So rather than going down while the stocks went up, it went sideways for 5 months. Total sleepiness, total support, and now it's reengaged again. It's not always, you don't always time gold with the stock market. But in major trends, it's inverse, especially major bear trends in the stock market. It's inverse to the stock market. It's always been, in fact, for 100 years it's been. Now, gold didn't trade back in the 1929s to 30s because, Roosevelt, okay, he took your gold away. But home stake mining went up like 1,000-fold. Okay, so gold miners went up while the stock market went down 80% over 2.5 years. Anyway, I think we're an interesting point, and I think the tipping of the stock market now that we've had the party and possibly the Fed tombstone on the market, a rate cut, we'll see. But if you ooze back down, handful of percentage points from where you are now, especially if you ever get back below the January price highs on the S&P, which is like, less than 10% from where you are now, the price guys are going to say, hey, I thought we had a breakout there. And when they realize it wasn't a breakout, they're going to get concerned. Momentum will get concerned before then. It's already broken. Momentum's broken long-term trends going back to 2022, whereas your price chart hasn't. Momentum has. So momentum is telling us now, don't trust these new highs. They're not likely to last, and they're likely to be teasers. And we'll find out shortly. I think that the $50 highs, you're looking at one of them there, and there was one back in 1980, are going to be blown to hell out. And we're going to end up with a surge, this move that we're in right now, that's likely to only pause in the $65 to $70 range. I've got some reasons for that. That's not a top. In other words, that's where I think the next pause will be. Pause of what you would call significant pause, where you actually spend 2-3 months going sideways or down. But until you see that gusher, I wouldn't be concerned about it. I think you're going to, that'll wake up the sleepy audience out there when you take out the $250 highs. And finally, by the way, copper's above its 2011 high. You know that? Gold's above its 2011 high. Why can't silver be above its 2011 high? Okay, maybe it's somebody made a mistake. Markets often do that. They underprice themselves and they suddenly, I catch up. And I think that's what silver's in process of doing here. Silver miners aren't as close to the 2000. Look at SIL, for example, SIL. It's in the 60s, and you'll know its high back then was in the 90s in 2011. So unlike GDX and XAU, which are above the 2011 highs, gold's above it, gold miners above it, silver's approaching. They're still a good distance away. But that recent action you see in SIL in price is more dynamic than it was in GDX even, and on a percentage basis. So when we run a spread chart measuring SIL price versus GDX monthly closes, what's their difference expressed as a percent? It's in the process of breaking out, meaning that it looks like the silver miners are in the process of shifting to an outperform mode versus gold miners. That would happen to fit with our view that silver's doing the same. The monetary metal area is silver and silver miners, less so gold and the gold miners. Though they're all going to go up together, I think that the silver components are going to go up far more on a percentage basis. A catch-up. You're pressing at it. Let me put it that way. You close the month out anywhere near 95%. I think right now it's, what do you say, 93.75 or 93.80. So you're about 1% below where that spread breaks out big time. Yeah. And I think you'll gush up out of this basing action, which goes back to 2022. You're where you were then. So actually, if you bought silver miners in 2022, right now you're doing just as well as if you bought gold miners, meaning they're at the same percent level. Doesn't feel like it, but they have. And I think they're about to shift to outperform. This base looks like it's ripe for an upturn on performance. And you could gush up pretty dramatically. And that would translate to price dynamics as well. I just think that in the next 3 months, you're likely to see some of these dynamics astound you. I don't think the incremental nature of the bull market we've seen in gold and silver, which has now gone more accelerated, admittedly, we're going to go even more accelerated. And I think you're going to see that reflected in other markets the other way. And once the asset class breakage occurs in the bubble market, the stock market, U.S. stock market in particular, that money goes somewhere. It always does. It doesn't get burned up. Yeah, some of it gets burned up, but a lot of it goes somewhere else. And gold is almost always the main, it's gold and monetary metals are the prime beneficiary. And so what we've seen in gold and silver is going to go more vertical, particularly in silver. And I think one of the factors there will be simply punch a hole in that stock market where the forever longs begin to doubt and move more money.
The Federal Reserve has signaled at least 2 more rate cuts before year-end, which adds fuel to an already powerful rally in gold and silver. Markets see this as confirmation that policy remains deeply accommodative despite persistent inflation pressures. Recent developments, however, point to something far more troubling beneath the surface. The appointment of political figures to central bank positions blurs the line between monetary independence and political agendas, eroding confidence in policy stability. When combined with proposals to merge Treasury leadership with the central banking authority, the last vestiges, meanwhile, institutions on Wall Street are making significant adjustments. Morgan Stanley's decision to shift its long-standing 60-40 portfolio model toward a 60-20-20 allocation, cutting bonds in half and introducing a substantial gold component, signals a structural change in investment thinking. This effectively places a sell recommendation on U.S. Treasuries at the very moment the government faces record deficits and soaring borrowing needs. The outcome is higher yields, rising costs of capital, and increasing demand for hard assets. These forces create a self-reinforcing cycle that undermines faith in paper markets while accelerating flows into gold. Let's get back to the interview.
The Fed indicated that we're going to get at least 2 more rate cuts between now and the end of the year. So bullish, bullish, bullish. And so gold's got no place to go but up. Silver's got no place to go but up. But let me get to these 3 other very significant, news items of the week. One is I watched an interview with Stephen Moran this morning on CNBC. Now, Stephen Moran was the head of Trump's economic advisors, who is now serving a stint as an FOMC member. So, he's wearing 2 hats, although technically one hat, he's got checked. He's going to go pick it up. So it's obviously a big compromise of Fed independence to have a member of the Trump administration infiltrating the FOMC. 2 startling comments that he made. One was he said that rates need to be much lower because he says the Fed is way above neutral. And not only is he wrong, not only are we not way above neutral, we're below neutral. We're too loose. The Fed should have hiked rates, not cut them. That's what the market is telling you. That's what the long end of the bond market is telling you. That's what the gold market is telling you. Nobody wants to listen to those market signals. Look at the money supply. Look at what's happening with consumer prices, right? We have high inflation, well north of 2% and headed higher. But I think an even bigger admission that should be even scarier if you're holding U.S. dollars and not gold is that Moran said that in answer to a question about the dollar, he said that one of the Fed's mandates is not a strong dollar or to worry about the exchange rate of the dollar. He says there's nothing in the Federal Reserve Act that mentions the dollar and that it's not up to the Fed. He said that the policy regarding the dollar, that lies with the president, right? Not the Fed, which should be very scary because if the Fed doesn't care about the value of the dollar, how is it going to deliver on its primary mandate of price stability? Because price stability relies on the stability of the dollar. Because prices are a function of the value of the dollar. If the dollar is losing value, you need more dollars to buy stuff. So in a way, when the Fed is mandated to maintain price stability, it is also being mandated to maintain the purchasing power of the U.S. dollar. So to say that the dollar is not a part of the Fed's mandate either means you don't understand what the Fed's mandate is or you're just lying. And so either, it's one or the other, but there's no, third option. So he's on the Fed, and Trump is going to appoint a new Fed chairman that is going to share that perspective. In fact, one of the president's closest confidants, or was at one time, Steve Bannon, he came out this week in favor of the president nominating Scott Bessent to be Fed chairman while he is still Secretary of the Treasury. In other words, Scott Bannon thinks that the chairman of the Federal Reserve and the Secretary of the Treasury should be the same person. One guy wearing both hats, or gal, depending on who's there. That is a horrible idea. I mean, often those two work together, but they shouldn't. There should be like a Chinese wall there. In fact, the Secretary of the Treasury, of the Chairman of the Fed, needs to push back against reckless monetary deficits and fiscal policy. They shouldn't be working together, and certainly they shouldn't be the same person. But that's what they're advocating. So this is a real collapse of the perception of Fed independence. Even if the Fed wasn't independent, there was a general belief that it was. And now that's falling apart because they're pulling back the curtain and they're showing everybody that there really is no Fed independence. So I think the dollar is going to tank. But more significantly, gold is going to rally and rally big. And one of the reasons for that is Morgan Stanley, just the other day, I think it was either Wednesday, maybe Thursday, but Wednesday, they came out and they officially adjusted the 60-40 portfolio. Now, the 60-40 portfolio is kind of like a mantra on Wall Street. It's how everybody should allocate their investments between stocks and bonds. And the benchmark is 60% stocks and then 40% bonds. And the only time they tweak it is as you get a lot older and you're retired, they will reduce the stock portion and increase the bond portion. But the standard cookie cutter model is put 60% of your portfolio in stocks and put 40% in bonds. Well, Morgan Stanley came out and said, we think that needs to be changed to a 60-20-20 portfolio. Still 60% stocks. They are reducing the bond allocation. They're cutting it in half. And they are replacing the half that they cut out with gold. So now you have a major U.S. investment bank telling its clients that now have 40% of their portfolio in bonds, that they need to sell half of their bonds and buy gold, right? Because the only way you can go from 40% bonds to 20% bonds is to sell half of your bonds. So in effect, what Morgan Stanley just did is they put out a sell recommendation on U.S. Treasuries, because U.S. Treasuries represent a pretty big part of that 40% that is allocated to bonds. Now, this couldn't come at a worse time for the Treasury, because the U.S. Treasury now has to sell a record amount of bonds, right? We have unprecedented deficits that were just exacerbated by the big, beautiful bill. Yet investors, if they follow the advice of Morgan Stanley, and if more major brokerage firms and investment banks follow their lead, because Morgan Stanley said that you need to do this as an inflation hedge, right? It's clear that inflation is going to be much higher than 2%. It's been above 2% for the last 5 years. The Fed doesn't even forecast it to get down to 2% for another 2. That's 7. And of course, that forecast is all BS. And I went over that in my other podcast. So I don't want to kind of steal that thunder. You got to watch it, because it's a startling observation that I made about a startling admission that nobody else is covering. But given that inflation has been so high for so long and likely to go higher now in light of the Fed's decision to cut rates, Morgan Stanley is saying you need an inflation hedge. You need to hedge your bonds. You can't have 40% bonds. You can only have 20% bonds. Now, I don't want any percent of my money in bonds, and so I'm already in gold and silver and gold and silver mining stocks. But most of Morgan Stanley's customers don't own any gold. And now they've been told for the first time to have 20% of their portfolio in gold. That's a lot of gold when you have zero. So Morgan Stanley clients and maybe other clients who are going to maybe get similar advice as the weeks and months go by, they have to sell all their bonds or half their bonds and buy a bunch of gold. So what does that mean? Well, first, for bonds, it means lower bond prices and higher interest rates, which also means higher mortgage rates, the opposite of what Trump is trying to achieve by pressuring the Fed to cut rates. So what does that mean? That means quantitative easing is coming next, right? Because that's the only way that they're going to get, at least in the short run, long-term rates to go down and mortgage rates to go down. But if they do that, they just create even more inflation and create additional incentives to sell bonds. And maybe it'll be a 60-10-30 portfolio, 10% bonds, 30% gold. And eventually, maybe it'll just be 60-40, 60 stocks, 40 gold with no gold.
Traditional assumptions about safety and stability in financial markets are crumbling. Bonds, once considered the bedrock of conservative portfolios, are now a source of risk rather than protection. Stocks continue to ride waves of speculation, but beneath the surface, the imbalance between debt, deficits, at the same time, institutions, and seasoned investors, this shift is not about chasing short-term gains, but about preserving purchasing power through cycles of inflation, monetary debasement, and market volatility. The evidence is mounting that real wealth endures in assets that cannot be conjured or devalued at will. That is where the smart money is moving, and why individual investors must recognize the bigger picture before the tide entirely turns. Share your thoughts on their analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.